I have to find it, but I want to show you guys this because this is the kind of research I do when I do full research on a company. I do research on its competitors as well. And I don't think I've shown you guys this because I haven't done this in a long time.
A lot of stuff.
Yes, so far it looks like I'm going to add about 100 to 150 new pages of content.
That's really a lot.
Okay, so this entire chart here, you guys see this, right? When I analyze a company and they have public company competitors, this is the kind of research I do not only into the company itself, so in this case Wendy's, but also to its competitors. So you see McDonald's here. And this isn't updated. This is from 2012. So this isn't updated. But the reason I do this, again, ROIC, ROE, I don't use really ROE anymore. I don't really use gross margin anymore, so these would be gone, but operating margin would still be there, ROIC, FCF sales, cash conversion cycle. Most of the rest of these would still be here. I want to do this amount of research because I want to make sure not only am I buying the best company, but if I do find another company through this research and through the relative valuations that's cheaper and more profitable and possibly better, I want to know that I'm potentially buying the best company, not just the one I'm researching. Does that make sense?
Yeah.
Okay. So this is something I've never showed you guys either. These two right here are metrics that I came up with. Well, this one, the total obligations and debt divided by EBIT, is a metric I came up with. To me, this shows how much obligations and debt a company has compared to its profitability. So the higher this number is, the worse or the more debt a company has relative to its profitability. So generally the worse that is, right? Correct? So you were talking about McDonald's. These are from 2005 numbers. Anything here catch your eye before we get to Wendy's and the asset reproduction valuation now?
The gross margin is the highest, one of the highest.
Anything else?
The return on invested capital is the highest. Cash conversion cycle. Is that the one you're looking at?
Well, I'm looking at several things. This is insane.
Operating margin, 5-year average.
That's
27.
just absolutely nuts.
For a hamburger shop.
Well, for any, I mean, it's insanely high because you can see the average here for the entire industry, but that's overinflated because of this number. That's absolutely insane for any company. 27.4. I look for anything over 10% on a consistent basis.
I don't know the specific metric. When I did my research on McDonald's, they were transitioning from a company-led, from a company-owned business to a franchise model, and I think that's why the margins increased.
Why is that important? Why is that important in this fast food restaurant industry? Why is that important?
Well, franchises have higher margin but lower revenue.
Yes, so they earn a lot higher profits in terms of the percentage of profits, and their costs are a lot lower because essentially they offload, the McDonald's parent company offloads essentially the entire running of the company to the subsidiary company or the franchisee or whatever. They have to stick by their operations manual and stuff like that and their processes, but their margins are insane. So that's generally a good thing. Does it mean that they don't have as much control? Yes. But if their manuals and their systems are good, which obviously McDonald's are, then it doesn't.
Yeah, I had a friend who was looking to start a McDonald's franchise, and they don't give it to any Dick and Jane. You have to have like experience. You gotta have money. You can't borrow more than 50% debt or all the whole shitty requirement. It's not easy to start a McDonald's
No, it's
franchise.
not. That's a good thing for them.
Not sure if it's the same in Italy. Matteo is. I don't
Yeah,
know.
I think here you need like more than $1 million to start one McDonald's.
Yeah, that sounds about right too. Through here.
You study to Hamburger University, that is their university.
I can barely hear you, Mateo.
You know?
Put the headphone on.
Yeah, you have like to study to Hamburger University.
Yeah.
I'm not joking. And actually, it's one of the it's one of the most difficult school to enter if you want to go straight to the Hamburger University, for example, to be a manager of McDonald's, maybe like country manager or manager of some region. It's one of the most difficult school to access because it's one of the best school of business. And so I remember that I was looking about that, and to open a McDonald's, you need more than $1 million, maybe now even more. And you need to study to this university, and you have to be the manager of your own McDonald's.
Why?
So,
Why do they want you to be the own manager?
yeah, because otherwise, I mean, that's the best guarantee that you can give to them, to be there and manage your own company, your
Yep.
own small. It's like a small business, small restaurant. So, because even if you have the brand and everything else, all the support that McDonald's brand can give you, you still can fail if the food is not so well cooked. And it's a fast food, but still to cook the food in a fast way and still to have the same taste, it's not easy. I mean,
Yep. Perfect.
so it's so strange, and I think that many other business fail, like franchise business fail, because they just want to make money on the franchisee. Like the ultimate goal is not to make a great company, but just to make money on the franchisee.
Yep.
So, okay, pay me, I give you the license, and that's the
Perfect.
plan.
So the next thing I notice here is this insane number.
Yeah.
Again, that's because their franchisee model, because their systems are so good, because the processes are so good, they make essentially double what the highest other competitor makes in terms of free cash flow.
Oh, that's crazy.
That's insane. I don't know if we've talked about the cash conversion cycle much. Do you guys know what these numbers mean just by looking at them right there?
It's like how much it takes for you to convert in cash what you sold, no?
Yes. So essentially this is how long it takes you to sell your inventory to customers, how long it takes to receive payments from those customers, and then how long it takes you to buy inventory with that cash you got from your customers to turn it into more inventory, and then you complete the cycle. Typically, the lower this is, the better. Do you know what it means when it's negative?
That you can't convert in cash.
No. So it's pretty rare when you see it's negative. Typically, this is reserved for companies, again, like fast food companies. You see their cash conversion cycles are really low. Amazon, Walmart, these kind of companies. What this means in a real world sense, when the cash conversion cycle is negative, is essentially the customer pays for the product or inventory or service or whatever before the company has to actually pay out any cash. So this is a great thing when you see this.
Okay.
So essentially, especially for, what is this, Chipotle? No, Yum Brands. So Yum Brands, What this means in a real world sense is they don't have to pay. They get paid on, let's say, day 0 from their customers for their product, inventory, service, whatever. And they don't have to pay out any cash for 36 days. That's what this means in a real world sense. Does that make sense?
Yeah.
This is an incredibly, incredibly important number that pretty much no one talks about. Frankly, I've never seen anyone else talk about the cash conversion cycle. To me, it's one of the most important metrics I look at. Ultra, ultra, ultra important. If the company produces hard assets, services, those kind of things. If it's like a tech company, like let's say Facebook, this number doesn't matter at all. But if the company has hard assets of any kind, and again, these are hamburgers and these are hard assets, essentially, this number is ultra important. Retailers, this number is ultra important for. Manufacturers, and on and on. Okay, anything else? Okay. What does this mean?
I'll just have you look at the share price return of Wendy for the last since 2001, so the last 10 years. They've actually outperformed McDonald's.
Well, take it from 2012 too.
2011.
2011, 2012, and they're like a 4x since then.
Oh, okay. They've outperformed McDonald's.
Yeah. I can tell you why, because again, I've researched them extensively.
Well, okay.
Okay.
Correct. Oh.
So before we get to that, though, remind me to do that to tell you why. But before we get to that, let's go to the asset reproduction evaluation. So this number on this page is pretty much the only one that means anything for the asset reproduction evaluation. What does that mean? What does that mean when compared to what we know about the asset reproduction evaluation?
That's assuming you want to sell the entire business and how much money you can get back, right?
Sort of. What is, okay, let's step back a little bit. What is the asset reproduction valuation? What does it cover? Which financial statement does it go over?
Balance sheet.
Yes. And what does the balance sheet figure out? At the bottom, what does it figure out? What is shareholders' equity?
The equity.
Book value.
So book value, yeah. What's
So
that?
right here, essentially, just by looking at this number, the 7.05 price to book is essentially, that means that at Wendy's current share price, it's selling at 7 times its net book value. Does that make
But
sense?
when you analyze it, it was trading at 0.9 times book value.
Yes.
So it's 7 times more expensive now. Is that
Yes.
what? Is that what?
So why is that? When I evaluated Wendy's, like I said, in 2011, 2012 timeframe, there was a ton of negatives about it. They had an enormous amount of debt. Their operations weren't producing enough cash flow to support dividends, share buybacks, and operations. So they had to continue to issue debt just to keep operations alive. Plus, they were reimagining their restaurants, which essentially means they're renovating their entire restaurant. So their CapEx was insanely high. So what I essentially found when I evaluated them the first time is I think I pegged their real world value at like $2.70 a share based on my evaluations. But I said in the article that I wouldn't buy them no matter what, because I didn't trust their managers to do what was in shareholders' best interest, because there was stupid related party transactions, like they could use the private company plane for, they weren't supposed to use it for personal uses, but it wasn't barred explicitly. Wendy's paid for security for the billionaire chairman, I think is what he was, of Wendy's, when he could easily pay for security for him and his family, those kind of things. So I didn't trust that managers had the best interests at heart. And what I said in the article is, unless they either change their strategy and operations completely or sell assets, they're going to have to continue to reissue debt or issue more and more debt just to sustain current operations. I also recommend that they stop the dividend as well to pay down some of the debt. So since then, I think, again, I pegged the value about $270 a share. I think their share price was around $450 a share. So it's about a 4 or 5x since then. So what happened?
Do you regret not buying?
No,
Jason?
not at all.
Ask you.
Not at all. Why? Because we've talked about this quite a bit, especially with Shafiq. Why do you think I don't regret it at all?
You want to take a stab at this, Mateo?
It's a tough one too. I mean, because you have like your criteria to buy some stuff, you know?
Yes. Essentially, that's what it is. It did not meet my criteria. I did not trust management.
No.
And at that point in time, based on the information I had then, I made the best decision I could then with the information I had. So obviously, you can't see into the future. And I don't like to play the hindsight bias game where, oh, I should have bought this just because it went up to 4x or just because it's been up 4 or 5x since then.
It's the same thing that the Warren Buffett about Amazon or Microsoft.
Yeah.
He was like, yeah, maybe it was a mistake or a stupid mistake. You can call whatever you want, but it was the best decision at the time, at least for me, he was saying. Because if I start to buy company without knowing what I'm doing, sooner or later I will even catch the company that will go down 5-10 times. So yeah, it's just a matter of time. Instead, if you know what are you doing, at least you know what was your mistake or not.
Yes.
It becomes investing and less of a game, you know?
Yeah, and essentially that's what I was going to say is essentially if I was doing that and I played that game back and forth between all the companies I've owned, essentially you're just guessing at that point.
Yeah, you don't even to do research because.
Yeah, exactly. So
wow, this business is on fire.
look at this. So their revenue has dropped significantly.
Yeah.
But their margins have gone up significantly since 2012.
And the net income has almost
net income exploded, earning per share exploded. They've been buying back more and more shares.
Why's the book value down?
Aha, good question. So let's go see. So this only goes back to 2014. But when I wrote the original article, they had an enormous amount of intangible assets and goodwill on their balance sheet that I thought was overvalued and that they would have to write down at some point. It's down, both are down a little bit since 2014, but I can almost guarantee since 2012, they wrote down these amounts significantly. What does that mean if they write down goodwill and intangible assets in a real world sense? What does that mean?
I'm guessing they overpaid for acquisition. They overpaid for acquisition.
That's goodwill, yes. That essentially, yeah, goodwill is an accounting measure, I guess, or accounting term for the amount you paid in excess of a company's book value. Intangible assets are things like patents, trademarks, brand names, stuff like that, typically.
Yeah.
If you write either of these down, what does that mean for the actual company?
I mean, you are taking out, if you take that out from the total assets, it's a lot. It's almost 2,000 that you take out.
Keep
So
going.
the really book value, it's much less.
Yes, and book value is a
than
sort of
what
a proxy for the value of the entire company, correct?
Yeah.
At least on a balance sheet level.
At least, yeah, that's true. So it's almost half of what they declare.
So let's see if this is still true. So this is, let's just round up and say 2 billion. Okay, so 3,626 minus. Okay. Aha, it is still true. So when you take out goodwill and intangible assets
Mm-hmm.
from assets on the balance sheet to find book value, or what I'm essentially finding now is called net tangible book value. Have we talked about that before?
What is?
Net tangible book value?
I think so. I mean, I
Okay.
don't, but I think
That's what it means.
Okay, so let me back up a little bit. So book value by itself is assets minus liabilities, whatever's left over is book value, correct?
Mhm. Yeah.
Mhm.
Tangible book value is you subtract from the assets goodwill and intangible assets, because most of the time these don't hold any real world kind of economic value. Now, in this case, because Wendy's is a pretty big brand name in the United States, there's some value here. But what I'm trying to find, or what I'm going to show you, is something that you pretty much you'd never see, especially on a giant company, is when you subtract the goodwill and intangible assets from the assets section of the book value calculation, and then you subtract total liabilities. Book value, essentially in this case, again, tangible book value is negative. What does that mean? I know we haven't talked about this before. Just kind of think about it logically though. What you know about the balance sheet, if a company has negative equity value, negative book value, what does that mean?
Does it mean the company owns more than it's worth?
In a real world, yes, that's true. But in a real world sense, what does it mean?
I mean that if they have a negative tangible book value, it means that if they cannot sell the company, they cannot have like property, other stuff to sell to make money.
Yes.
On a level, I mean, they have to liquidate the company.
Yes. So just to elaborate on that, essentially what this means to me is this company's balance sheet is jacked up.
Yeah.
So when I look at a balance sheet, I want a margin of safety on the balance sheet. I want little to no debt, lots of cash, lots of hard assets that the company could sell if it needed to raise cash. Wendy's is the reverse. Wendy's, essentially, another way to put this is Wendy's balance sheet is a negative drag on the company's value. Does that make sense?
Like, I mean, you mean that they made up the numbers in some way?
Well, okay, let me rephrase. So if a company has negative tangible book value, thinking of as a whole business owner of the entire company, if we were to buy Wendy's right now today, we would pay, in terms of market value, about $4.5 billion. Probably more after fees, and so probably $5 billion, something like that. But if I were to go in there and say, hey, what are these goodwill and intangible assets? I don't care about those. I don't want those. Maybe some of the goodwill or maybe some of the intangible assets I'll pay for because it's trademarks, brand name, stuff like that. But I don't want any of the goodwill and I don't want most of the intangible assets. So I think I should pay $3.5 billion instead of $5 billion, because this is about a $1.6 billion negative on the balance sheet. Does that kind of thinking make sense?
Yeah, but you still have the liabilities to pay.
Yes. Yes. So And that 3.5 billion is almost exactly equal to the liabilities.
Mhm.
Yeah, so it's worth zero at that point.
So essentially what you're paying for if you were to buy this whole entire company is you're paying just for the liabilities.
Yeah, so if you pay that amount for the company, you still have all that liabilities. So
Yes.
you are not getting any more like any more value to your acquisition
Yes.
other than the brand. But with just the brand and all that debt, it's difficult to run a company. I mean,
Yes.
it's not easy. I mean, at least. I mean, it depends how you will use that brand, but how much can be valued that brand, you know?
Yes.
Because
So
you have to pay back the debts, so it's like you're paying 7 billion if you pay 3.5 billion for that company.
yes, exactly. So to further illustrate that point, shareholders' equity is essentially book value, correct?
Yeah, no.
But again, this doesn't include, if we were to subtract the 2 billion in goodwill and intangible assets, this company essentially has a negative book value.
Or 1.5 billion.
Yeah, about 1.5 billion. So that's what I meant by the $1.5 billion drag on the company's value.
Okay, yeah, I understand that.
Does that make more sense now?
Yeah, it makes much more sense, yeah.
Okay, so this is all important. I want to make sure don't see anything major on the cash flow statement before we go to the reproduction valuation. Yeah, no, we need to go over that later. Okay, so the quarterly. Okay. Okay, cash is 414 billion or 414 million. $14. Receivables 111. You want mind reading off these numbers to me? It'd probably go quicker.
Like you go.
Okay.
Yeah, just go straight down here and say the number that's all the way over here to the right. So what's next after accounts receivable?
Numbers.
Equity and other investments. What was this number? Do you guys have it up?
So is it total shareholder equity?
No, right here. On the equity and other investments, 285.
Different number. Do you have the Wendy Co Class A? Is that the one?
Yeah. When is the ticker? WEN. Are you on annual or quarterly right here?
Oh, I'm on annual. Are you on quarterly?
Yes. You always want the most recent numbers when you're doing an asset reproduction valuation.
But that's only good for 3 months.
Yeah, no, the balance sheet, you just add up the numbers. It's not like the income statement or a cash flow statement.
Oh. Yeah, but isn't it every quarter?
What?
But if you put the statement type to every quarter, then you're gonna have like every 3 months.
I don't understand what you're saying.
Like, you know how if you split the statement type to quarterly for the balance sheet, then you're gonna separate the balance sheet into every 3 months.
No, because we only do this with the most recent numbers. We don't do this. Well, I mean, you can do it every quarter, but you just need to update your numbers every quarter. These don't add up to trailing 12 month. Like, see, there's no trailing 12 month over here, like on the income statement. This is just what the company has on hand, on hand as of this time.
Oh, right. Okay.
1, 2, 6, 4. Other long-term assets. This has gone up a lot in the last quarter. Just
What's the long-term asset?
depends. It's usually a catch-all. You have to go to the footnotes to see what's exactly in there. Okay, so I'm going to add this up first. Total assets, 5186. Okay, and here's where I need to make a little explanation, because when I first was doing this, I made a mistake. I forgot that you include the liabilities in this. When I first started doing the asset reproduction valuation years ago, I forgot that you're supposed to include liabilities, because liabilities are a real world expense. Again, as a total business owner, you want. When I used to stop right here when I did the asset reproduction valuation. But you have to include the liabilities, because again, we want to think as total business owners of the whole company, and we want to know what the liabilities are, correct?
To take the total liability, right?
Well, I keep going down. Just so I know what the liabilities are, but you don't discount the liabilities. You discount the assets because you can't always get full price for those if you want to sell them, which I'll get to in a second, but liabilities you're pretty much always going to have to pay.
So just take the total liability, right? 4.5 billion.
No, I go through the whole thing just so if I go back, I can see exactly what went into the thing. Because I save these sheets. Like, for example, not necessarily the ones I worked on with the first edition of How to Value Invest, but now I save everything. So if I do an asset reproduction valuation for a company I evaluated 4 or 5 years ago, I can go back and look at
Okay.
it. Sorry about the coughing and clearing on my throat.
Okay. Yeah, we'll read out the numbers for you if you want.
Yeah.
So what is it? We up to
Accounts payable.
Yeah. So the next one is taxes payable. Which I had at nothing for some reason. Double check that.
Yeah, it says 0 on my end.
And then it's accrued liability, which is 141. And then is other current liability. And then is 90. And that total current liability. Like that what you just wrote down is just
Okay, yeah,
So
just
the
skip that. Go
total
to the
is-
long-term liabilities, please.
Okay. Long-term debt, 2302. Then capital leases, 1416. Then deferred tax liability, 268. Other long-term liability is 235.
And total liabilities?
Total liability is 4545.
Okay. Anything catch your eye on the liability side of things?
Long-term debt, obviously. That's pretty obvious.
Long-term debt and capital leases. Long-term debt is pretty self-explanatory, but what are capital leases, do you guys think?
Is that rent? Huh?
It could be. I mean, it's, to me, or most of the time, it's capital leases are things, actually, yeah, rent would probably be on this. The equipment that they have to pay for, stuff like that, that they have to replace all the time or whatever, stuff like that. So most of their liabilities are on long-term debt and capital leases. What does that mean kind of in a real world sense? What does that mean? At least in terms of the health of the company's balance sheet.
So it's the same like how much money it costs to run the business.
Yeah, so it's a high
Right.
capital intensive business, which is the capital leases, but what the long-term debt, that doesn't necessarily explain the long-term debt.
Long-term debt, borrowing. They're buying back shares, right? They fund the capital program somewhere.
Yes. So that still means they're obviously buying back shares, but they're still likely funding the buyback of shares, the dividend, the operations with debt. This also means, from a real world perspective, these two things, as a total business owner, this is what, $3.7 billion. Most of your capital is tied up in long-term debt and capital leases.
This is the same for McDonald's.
These are
They're
things
doing
you
the same.
have to pay over time. Have to, or you go out of business. Okay. So liabilities, you keep the same. 53, 16, 0, 1, 90, 2, 6, 5, 4, 5, 4, 5. Okay. So let's go up here now. Mateo, I think we've done reproduction valuation before, right?
No, we did one time, but I missed now the part about the capital leases that you were talking about because my connection went off. I don't know.
Oh, okay. What I was saying about the capital leases is that as a total business owner, these are $3.7 billion in liabilities you essentially have to pay or you go out of business.
Yeah, for sure.
And it's a massive drag on the company's operations and expense ratios as well.
Mm-hmm.
I thought
Because
McDonald's doesn't have capital leasing.
they probably either own their equipment already because they can buy at such scale that they don't have to pay over time for it, so they can just pay up front at a cheaper price. Also, some of it's probably because they don't own the land at a lot of these restaurants anymore.
McDonald's owns the land, right?
No, they own the land, but I think they lease it, so they might have it I think they have it under a different. They might have it under a different terminology.
Right. So there's different business model, right?
Yes. So McDonald's is actually more of a real estate company than a fast food company.
Wendy's more of a fast food company, right?
Yes. Wendy's is more of a fast food company that owns some of its real estate. McDonald's,
And McDonald's owns
and then the value of their real estate
Yeah,
is
no, that's it.
astronomical. There's actually been talk for years that they should spin off their real estate into a REIT.
No, that's not gonna happen.
I don't think it should happen. That's one of their most valuable assets. Okay, so reproduction valuation. Me and Mateo did one of these a while ago, so I'll go over it pretty slowly. David, we haven't gone over this at all, right?
No.